An important aspect of retirement planning is managing risk because understanding how risk can impact your financial security is crucial when you're planning for what could be 20, 30, or 40 years of retirement. My guest is Mark Henry in Charlotte, North Carolina. Mark, thanks for joining us today. And I guess when we start talking about risk, most people just automatically think we're talking about market risk, but that's not the only one, is it?
Sure, Scott. There's an awful lot when it comes to risk. The first one, obviously, is market risk. People are always concerned about losing money, but there's another risk that a lot of people don't think about. It's one that I like to refer to this way: living too long. Think about that now. Why would that be a risk? Obviously, we want to live a long time, Scott, but you know what? The idea is, are we going to live so long that we run out of money? That is certainly a big risk. Other ones are long-term care risk, inflation risk. There's a multitude of factors that have to go into a proper retirement plan, and risk is certainly a big one.
So Mark, thinking again of longevity risk and people now living much longer in retirement, some advisors are now thinking that it's appropriate to recommend adding more risk to a portfolio because of this longer investment horizon. Is that something you agree with?
Yeah, it doesn't make sense at all, Scott. So think about this. First off, I like to think of risk this way. Risk is 100% okay as long as you're willing to take it. So what I mean by that is risk is different for everybody. I have clients that feel like a 10% risk is a lot. Other clients might feel like 25. First, you have to determine what are you willing to lose. Think about it this way. A client's getting ready to retire, and it happened to be, say, November of 2007. And they've got it all planned out, they've worked hard, and then all of a sudden something completely beyond their belief happens in a 2008 market reality, and it changes their entire retirement trajectory. I mean, everything changes. So I don't advocate something like that happening again, but the answer is they have to be prepared for that. That has to be part of the equation. What is the worst case scenario, and what would happen if that happened? And that plan has to be done before the event actually takes place.
So Mark, if you were in retirement, would you have risk in your portfolio?
Sure I would. It would be a balanced portfolio that manages, I guess, think of it this way, the old adage about not putting all your eggs in one basket. I would not rely on any one sector of a market, nor would I rely on any one type of investments. I would have a holistic plan that allowed me to mitigate my risk by saying I've got this basket, I've got this basket. Maybe, hopefully they'll all perform at the same time, but you know what? When one's not working, hopefully the other one is, or at least it's not losing.
Mark, thanks again for your time.
Thank you, Scott, for having me on.
My guest has been Mark Henry in Charlotte, North Carolina. Thanks for watching Retirement News Online.